Good afternoon. I'm Ian Stewart, Chair of the Board of Leithner Company, and I welcome you all to the March 2026 video from Leithner Company. In our forthcoming half-yearly report, I write to you regarding that well-worn phrase, "We live in interesting times." Today's video will amplify that context and look at the opportunities that abound during these same times that we live in. So I am happy to report that our joint managing directors, Mr. Chris Leithner and Mr. David Guy, will speak to the slides facilitated as usual by my fellow director, Mr. Chris Satsophilis. With that, over to you, Chris.
Thanks, Ian, and welcome everyone. Before proceeding, please pause the video to read the disclaimer at your own speed. In today's update, we'll have Chris run through our medium and short-term results. We'll look at the asset allocation and the top 5 holdings of the portfolio. We'll also talk about how we use options to add to our holdings and run through Flight Centre as an example of that. And then I'll conclude the update with just some information about how to contact the directors if you're interested in investing with us. Chris, over to you.
Thanks, Chris. Since January 2020, each dollar invested in our redeemable preference shares, RPSs, has compounded to $1.56. That's after tax and including dividends, and is equivalent to a compound annual growth rate, a CAGR, of 7.5% per year. As a result of its sharp drop this month, an equivalent investment in the All Ordinaries Index on a pre-tax basis and including dividends has compounded to $1.53. That's equivalent to a CAGR of 7.1% per year. So over the past 6 and a bit years, we've slightly outperformed the index. Crucially, we've provided a competitive return, not by outperforming on the upside, but on the downside. As you can see in the graph, we avoided severe and extended losses during COVID-19 in the 2021, 2022, 2024, 2025 financial years, and now in the month to the 26th of March, 2026. Okay, let's go to the next slide entitled Monthly Performance versus Benchmark. What's happened over the past 6 months provides an example of what's occurred since 1999. We often underperform when the index rises strongly, and we greatly outperform when it plunges. We didn't match the index's strong gains in December, January, and February. Equally, we've avoided its sharp drops in November and particularly this month. So far this month, to the close of business on the 26th, the All Ords Accumulation Index is down about 7%. In contrast, we're up about 1%. Over the past 6 months, we've outperformed. Our compound growth from September 2025 to the 26th of this month is 3.3%. In other words, each dollar invested in our RPSs, including the dividend we paid in February, has grown to $1.03. In contrast, the index's compound growth from September to the 26th of March is minus 3.2%. Each dollar invested in the index, including dividends, has shrunk to 96.8 cents. In one critical respect, the past 6 months has been representative of past results. We're the tortoise, whereas the index is the hare. To see that, let's go to the next slide, which is entitled, Our Most Recent Results Are Part of a Pattern. The current war in the Middle East could well be the 4th major crisis since Leithner & Co.'s formation in 1999. The dot-com bust of the early 2000s was the first, the GFC was the second, and COVID-19 was the third. This slide shows how we did compared to the index during those 3 crises. During each crisis, we fell far less than the index. We also recovered our losses much more quickly than the index. Okay, let's go to one last slide entitled Extremely Conservative Asset Allocation before I hand over to David. The crucial point of this slide is that over short, medium, and long terms, we've performed well because of, not despite of, our conservative asset allocation. This allocation puts a firm floor under our returns, and it also gives us huge amounts of dry powder to deploy at times like the present, when others, it seems, are getting nervous and perhaps even panicky. So with those thoughts in mind, David, let me hand over to you.
Thanks, Chris. As at the 26th of March, so yesterday, this is the top 5 holdings. The reason we've done reasonably well this month is twofold. As Chris said on the previous slide, we have a lot of cash and interest-bearing securities. So we're making a good amount of money in terms of interest, but we're also not running any risk of capital loss on those. Over and above that, the assets that we hold, the shares we buy, tend to be good value and cash producing. The top 5, as you can see, are Origin, Santos, and Woodside is number 4. All of those are in oil and gas to one level or another. Origin also obviously has a large retail electricity business. We also have APA, which is a large gas pipeline. It's not going up because of the Iranian situation. It's going up largely because it's a stable company. It's a very, very large gas pipeline business. The revenues and the cash flows will be very stable. And the last one is Horizon, which transports metallurgical coal largely, but also has some reasonably significant general transport operations. So twofold are the reasons that we've done well this month. Large cash backing, but also the underlying shares that we hold have been performing pretty well also. Just for the next one, Chris. Thought we'd just go into a little bit more detail on some of the stuff we've been doing this month. One of the larger things we've done is write a fair few put options over Flight Centre. We've written, as you'll see on the next slide, about 5 positions. One other thing we've done is topped up our position in Charter Hall Longwell REIT, but that was a smaller operation. We'll continue to buy things as they become attractive. We're not rushing out. Just because the market's fallen a little bit doesn't mean everything is suddenly on sale. But slowly, methodically, we're picking off things. So when we write put options over something like Flight Centre, it's only time we do it is when we're doing it over a company we want to buy anyway. So these are companies that we've researched extensively, we're happy to buy, and writing the put options is just another way to purchase them. In terms of Flight Centre, last year we've been writing put options over them as well. Most of those expired. So what happens then is we'll write a put option at, say, $12. If at the expiry date of that put option, the share price is below $12, we'll end up with it. If it's above, then we keep our money and we don't get the shares. So that's what happened last year. Flight Centre, we wrote put options over it, and then Flight Centre bounced up to the $14, $15 range. This month, this opportunity from Iran has given us a chance to write a fair few put options, as you can see on the screen there now. 5 lots. The way to think about this is when we're buying them, one of the more difficult things is to know exactly when to buy something. This gives us a little bit of security. So we buy them by writing put options. The bottom one there is a strike price of $12.50. So that requires us to buy Flight Centre shares at $12.50. Now, at the moment on market, they're selling at about $11.10, having fallen a bit further since we wrote these. But for that $12.50, we received $1.11 in premium. That means that our net purchase price will end up being $11.39. So it's just provided us with protection when we're buying it, just to help us average into these shares at a good price. As it kept falling, we kept writing some more options. As you can see, $12.25, $12, $11.75, $11.50. When you add all of that up, we've been able to get into it during March at an average net premium of $11, which is about what it is. So it's been very, very effective in making sure that we didn't put all of our money in at $12 and then find that it fell to 11. It's helped us smooth our way into that. Now, if it ends up at the end of June, which is the expiry date there, if the share price of Flight Centre is below $11.50, we'll end up with all of those shares at a net price of $11.05, which we're very happy with. If the share price of Flight Centre goes up and it is above $12.50 at the end of June, we won't get any of those shares. We'll just keep the $100,000 of income that we've received this month. So as you can see, the biggest risk we have with this is not getting the shares. We want them longer term. So ideally, we'd end up, as we have been, with maybe half of those options, and then we can write some more next month or next quarter. But it's a very, very safe way to get ourselves set in some of these companies. Next slide. Why do we own Flight Centre? Why are we interested in it? It's very large. It's one of the top 10 travel companies in the world. The travel industry has hiccups. I mean, we had hiccups in 9/11. We had hiccups in COVID. My goodness, massive hiccups in COVID. It bounces back. And it bounces back because people like to travel. Business-wise, also domestic, retail-wise. So we believe travel will bounce back. In fact, if you look at the moment, people aren't routing to Europe through the Middle East any longer, obviously, but the flights through Asia are busy. The flights even through America to get to Europe are busy. So we think it'll continue. As we've seen, there's some temporary difficulties there. We think they're overstated. And as the last slide says, the tailwinds for the industry relative to the price we're buying, we believe will ensure we get good returns over time. That's the end of that slide.
Thanks, David. I'll just summarize some of the current metrics. Our current net tangible assets are 98.3 cents per redeemable preference share. Our market capitalization is close to $37 million, and we intend to soft close at $100 million. If you're not already a shareholder but are interested in finding out more, you can contact either of the joint managing directors, Chris or David, initially by email or by contact phone to set up a time to meet either in person or electronically. And there's further contact details on the next slide. And with that, I'll say thanks for joining us on this update, and we look forward to seeing you at the next update. Thanks, everyone.
Thank you, everyone.
Thanks.